Welcome back, everyone. Trading 212 has given us a belated Christmas present or a New Year's Eve Christmas present by releasing its new accounts on Companies House. I don't want to take up too much of yours or my time looking through this, so let's get to it and let's get to the best bits. Welcome back, everyone. My name's Paul. I'm brand new to investing and I have a dividend reinvestment portfolio here on Trading 212. Currently, my portfolio sits at 48.50, but we don't care about that today. We want to look at Trading 212 and see if it's a great platform to sit our money with in the future. I try to look at Trading 212 in a similar way to how I would look at a stock because I've got a lot of money invested with it and I want to know that this new fintech platform is going to stick around for the long term. I want to know that my money's safe, and I do this by looking at its accounts and keeping up to date with all Trading 212 related news. Trading 212 have finally released their Trading 212 UK Limited accounts. This is the UK side of the business. This is different from Trading 212 Group, which is usually a lot bigger and has a lot better results. So Trading 212 UK is a great indicator of what the bigger results are going to be like in the Trading 212 Group. This caused a lot of controversy a couple of weeks ago for absolutely no reason, and it seems that Trading 212 have either released these results late because they normally do, the FCA might have needed a little bit more time to go over the accounts possibly, or most likely it's a lot better written this year. There's a little bit more care gone into it, which possibly led to this being quite late. And it's worth noting that these accounts are still a year out of date. That's just how Companies House works. But these accounts are only made up to the 31st of December in 2020. That means these accounts take in all of the rush that happened through March 2020, right the way up through December. But it does not take into account the massive rush in January of 2021, where Trading 212 probably earned a lot of revenue there. So while they are a year out of date, they contain a surprising amount of info. Should we start with the headline? Trading 212 is not going bankrupt. I can't believe anyone would have said that. Trading 212 in 2019 had revenues of 2 million. In 2020, that increased to 54 million. Just by doing a small calculation in my head, that's a 2,600% revenue increase in 1 year. That's absolutely massive and instills quite a lot of confidence in Trading 212 for me. So that's the headline for me here, that in 2020, they made a ton of money, and in 2021, it's very likely with all GME and AMC and all that, that they made a hell of a lot more. As usual, I'll look at total assets versus total liabilities on any business that I go through, and it looks here like Trading 212 again scores a big point by vastly outperforming its liabilities. And also with another highlight that I really like to point out here is again another year where they have taken on zero debt. It's very unlikely that a company is going to go bankrupt if they have zero debt. But Trading 212, as usual, is not without risks. It is a CFD platform at heart. It's shown that Brexit has caused Trading 212 to split into two companies, which again means the Trading 212 Group is probably going to earn a lot more money than the Trading 212 UK is. And this is what I mean when I say these accounts have been written a lot better this time, with liquidity risk here, giving a bit of reassurance that they realise that they have to ring fence money accounts and they have to comply with all the FCA rules. And down here is another interesting one, which is the impact of COVID-19. It is an uncomfortable truth that the volatility spikes resulting from the pandemic have facilitated increased trading volumes. In the short term, the company has been a beneficiary of both revenue and growth. Longer term, remote working has made it more difficult to hire staff and cause stress on some systems. Now, to me, that's a little nod to the fact that they have had to close down. They simply had too many clients and could not keep up a great service if they didn't have the customer service or, of course, the scalability of their systems. This really does, to me, point to the reason why they have closed for such a long time. They make another nod to this on page 6 in part 4, where they've said they've increased the headcount in the UK from 6 to around 30 at the time of approval of these financial statements. People seem to believe that because Trading 212 has a well-designed app and it's got out to a lot of people, that it has a huge headcount here in England. But in 2020, it had 6 people, and now it's still only got around 30 people. So it was clearly very hard through 2022 to keep up that level of efficiency that the app is well known for. If the app had started to have really big problems through 2020, that would have arguably been more detrimental to the business itself rather than just shutting down and being ready to take on more clients. And for anyone who's been on that UK waiting list for over a year, congratulations, because the company now expects to start onboarding new customers in early January 2020. Get yourself clicking that link in the description below. However, there is one actual uncomfortable truth here, and that's that none of this 54 million in revenue has actually come from the invest or ISA accounts. Yep, it looks like in 2020 and 2021, investors are still as dumb as ever, losing 54 million in CFD trading. How the hell did we lose that much money to trading 212 in the biggest bull market that the world has ever seen? Because remember, in CFD, trading 212 profits from the losses of its users. But there is positive news that Trading 212 is shifting away. We did know that already, but they have stated that the focus of the business has shifted towards stockbroking, which did not generate any material revenue for the company during the year. While the company has a pathway towards monetizing this line of business, during 2020 it remained in the growth phase. This growth strategy has seen the client money and asset balances rise from 21.7 million to 2.1 billion over the year, increasing further to 3 billion in 2021. So from this we can deduce while we had a big burst in revenue and asset growth in 2020, that growth has actually slowed down somewhat in 2021. That's just in asset size. We can't comment on the revenue, but the guess may be that they will go hand in hand. That's absolutely pure speculation though, and I wouldn't be able to provide any evidential reason behind that. They go on to say that market volatility has been extreme at times, and during the year, and coupled with increased numbers of clients staying at home during the COVID-19 pandemic, conditions have been generally good for trading. Now, I think this is a bit of a risk for Trading 212, because as we go through the bubble and maybe back to work and maybe up to doing just generalized things, brokers such as Trading 212 may become a little less popular. It's going to take some time to get the share lending thing going properly. I was only really making share lending videos in around July 2020, so that means maybe only 6 months of share lending has started to really take hold here. It's possible that in 2021, share lending had much more of an impact on their revenue. So while these accounts are already out of date, and some people out there will be treating it like they are well in date, Trading 212 is showing nothing different from an extremely high growth company. Record revenues, record income, and record assets. It's the sign of a bubble, guys. And almost all of their revenue has been brought in by dumbass investors investing in absolute crap. I really hope that Trading 212 has started to make great revenue on its invest and maybe even its ISA account. That way, Trading 212 can start contributing positively to the investment world. I don't know why, but I feel kind of bad here that I'm pointing out that Free Trade released their statement for 30th of September 2020 with an operating loss of 8 million. They also seem to be running their entire platform off of crowdfunding rounds. It just feels like here within the UK no commission trading and investing apps, there just doesn't seem to be much of a comparison.